Let what you love be what you do. Hello and welcome. This is Huskins, your Forex mentor. Welcome to the review of May 2nd and preview of May 3rd, your daily dose of events that shape the Forex markets. Since we had no trades today, there aren't any results, but I'm going to yet be sharing my charts with you about one interesting event which happened in the market today, and I'll share my thoughts and opinions on that. At about 7:45 Eastern Standard Time, you could see this chart, Euro USD chart, where we had the interest rate announcements from the Eurozone. And I'd mentioned in the past that the market had already priced in 25 basis point reduction in the interest rates, and that's what it got. And you know, interest rate announcements and major news, a lot of folks, they try to straddle them. Now straddle is a very dangerous trading strategy. The way they like to place their order is they just before the news, they place an order 10, a stop buy order 10 pips above, and a stop sell order 10 pips below the market. And what they do is, now I'm just giving 10 pips as a placeholder. It could be anywhere from 5 to maybe 20. So the idea is that if the market's going to go up, it'll take their order in and it'll continue to move in the upward direction. Now, the problem with that is that after the interest rates were cut, the market did fall and then reverse back up. So you would get an entry short out here and you'd get an entry long out here. You'd be stopped out in both your trades. So and then the market fell. I mean, when I say the market, I am talking about the Euro USD. It fell and it stabilized towards the end of the day. So, in short, there wasn't a decent trade possibility on this whipsaw news, and that's why we did the smartest thing. If you don't know what you're doing, stay out of it. And I am no uh, I'm not ashamed to admit that I had no idea what to do with the ECB rate announcement, and we did the smartest thing, which is staying out of it. Now, I'd like to share with you an interesting discussion I had with Rick about why, at about the time from the news of um, the ECB cutting the interest rates, why did the yen all the more become, start becoming weaker? You see the USD JPY, it rose from almost at that time. Now, the long answer is a bit complicated. The short answer is that so far we had two funding currencies, which is the US dollar and the Japanese yen, amongst the most stablest. The most industrialized nations in the world, and their currency, which had the interest rate close to zero. So anything which you need to sponsor for a risky investment like the stock market, real estate, or any risky investment, you would fund that through low risk currencies such as the yen or the US dollar. But now we have, in addition to the yen and the US dollar, we have the euro. So now euro is soon going to become a funding currency, and that's it is like we have a substitute for the yen now, and we have a substitute for the US dollar when it comes to the funding currency. So that's something which I actually wanted to share with you all. Now, there's a very interesting discussion with the Fed had. Basically, they said that if the economy falters, the Fed will expand bond purchase. Now, what is this bond purchase? Now, basically, right now we have QE infinity going on. What is QE infinity? QE infinity means that the Federal Reserve, it is buying bonds at 85 billion a month. And it's not like they're buying it for 1 month, 2 months, or they'll continue to buy it for a year. They've It is infinite. They're just going to keep on buying it. So what does this mean? They're just printing more money from thin air to buy the bonds which are available in the market, so that pressure is put onto the stock market to get inflated and the stock market rising. So um, so this is the theory, is that with the stock market rising and people not knowing what to do with their money, they'll start investing in businesses, and that will lead to employment, yada yada yada. But that's not happening. But the Fed has is yet in love with their infinite Fed buying program, and they think that if things are not working, they need more of that to give it a better shot. So policy makers basically repeated their concern that the unemployment level is too high, and they said that they will keep on buying assets until there is a significant improvement in the labor market. Now this reminds me of a doctor whom the patient has died, and is keep on giving the patient shock after shock after shock. I'll keep on giving it shock till it actually revives. So maybe sometimes that's not what one has to do, but we do not make the Federal Reserve decisions. What we do is we follow what the markets might do based on the decision the Federal Reserve makes. Now, a lot of folks have emailed me and asked me basically what is the monetary policy and what is the fiscal policy. Basically, they are two distinct tools which any government has. Monetary policy, as the name suggests, it is money based. So, how much money is circulating in the market? If you want the Keynesian theory says that if you want the market to grow, you have more money circulating in the market. If you want to restrict the growth, you pull off liquidity from the market. So what has been the traditional means of monetary policy? The traditional means has been interest rates. So when you want the market is expanding too fast for you and you're concerned about inflation, you increase the interest rate, thereby reducing the amount of money available in the market and slowing down growth. And when there isn't any growth, you have to keep on lowering interest rates, so that people lend each other money, because now uh, money sitting and doing nothing does not get any return. And the idea is that now the entrepreneurs will think that, okay, I have a few $1 million lying around, I cannot get any guaranteed return on that, maybe I need to start a business and employ people. The fallacy of that is that whenever a lot of these investments, they have not gone to businesses, but instead they go into um, inflating the stock market. Now, what is the difference? The difference is that the businesses in the stock market are already established, the ones which have already provided the stock. Now, if I were to go and start a new business altogether, I might have a chance at creating more employment. But if there is a business which is worth $500,000, I go and I buy that business for $800,000 because my money does nothing. The idea, in my opinion, is that you're not adding to any employment out there. You're not adding to any growth when it comes to monetary policy. So but a little rundown on what the monetary policy is and what the central governments want to do. Now, what is the fiscal policy? The fiscal policy deals with um, taxation. Basically, the government are the only people who have armed personnel as their revenue collection agents. They can employ the police, they can employ the military if they want to, and they can get people to pay taxes. So the higher the tax rate, it is a more restrictive policy. The lower the tax rate, it is a more expansionary policy, because again, the assumption is that if if there aren't going to be much taxes, entrepreneurs might want to take the risk and get into new businesses. While as in case there are going to be very high taxes. Let us say, for argument's sake, if we had a 90% tax. Now, if I were to think, why am I getting into business? If I make money, government's going to take 90% of my money away. I'm not going to, there's no need for me to attempt to make money. So conversely, if it was a 0% tax, I'll say, all right, if I make money, I can keep all of it. Let me pool in my resources and get into business. So that's what the monetary policy and the fiscal policy is, and I hope I've made myself clear on that. If not, you can always send me an email. Now, I brought up a very interesting topic. The Japanese monetary base expands to 1.54 trillion. Now, this is responding to the Bank of Japan's newly adapted aggressive stimulus. The monetary base expands to a record high of 1.54 trillion last month, which is a 23.1% increase compared to April 2012. Now, I want to share with you something. Okay, this is the US dollar JPY chart, the daily chart. And what I've done is I have printed the price of USD JPY in April, and I have printed the price of USD JPY in April of 2013. So basically, what the numbers are telling us that there has been a 23.1% increase in the yen compared to last year. All right. So the idea right now is that if all things equal, if yen is the only moving factor in the USD JPY pair, what we should do. Uh, what we should have is um, 24% or a 25% increase in the value of the yen, and right now, or decrease in the value of the yen. But right now, based on the this particular level to April's level, we had seen a increase of just 15.49%. So my idea is that if we were to look at the monetary base expanding by about 24%, 23 to 24%, we should see the USD JPY to these levels of 101.716. So this is what the the single just based on monetary policy expansion alone. But having said that, we also know that the US dollar is debasing its currency. So, Japan is printing more money, so is USA. So it might not be an accurate measure, but this is a level which I would yet expand it or look at a potential target of 101.66 on the USD JPY. I will do that because over the last few years, um, you'd had yen strengthen against the yen strengthen against the US dollar, and now when such an active debasement is being done, it is just natural for it to at least hit the target of what the debasement would have been. Eh, though, in my opinion, it could go up to as high as 105ish, but this particular area, but 101.66 is our target based on just the monetary expansion. Now, for further news, we have the China's yuan at an all-time high versus the US dollar. The Chinese yuan rose to a record high exchange rate of 6.2082 to the US dollar according to the China Foreign Exchange Trading System. Now, the development comes as the yuan's role in international trade is rapidly increasing. By 2015, the yuan will be one of the three most important global currencies, according to the forecast by HSBC Holdings. Um, Another thing which I like to add out here that I had mentioned about investing in China and not investing in China at a few months ago. I talked about investing in sovereign bonds of China. There you get about 6% interest rate plus increase in your monetary, the appreciation of the yuan. So you'd get all in all about a 10 to 12 easy return per year. That is what my investment advice was, and we very well above our targets if somebody had taken that. And I also remember I had said that that there is a big financial crisis brewing in China. So I'd said do not invest in the Chinese stock market because and especially not in the banking sector in of China, because the loans which are lent out in China are of very low quality. They are even though the banks know that they're not going to get their money back. So far, they are just staying in the game by rolling over the loans. They're not the loans aren't coming back to them. They're just extending these loans, and that is why the banks in China are yet floating. But when it comes to the Chinese economy, they have the real manufacturing base. So if at all you want to invest, the Chinese sovereign bonds is a good place. The banking center bonds or the stock market in China is not a very good place. So that's again what my advice is. It's not an investment specific investment advice. It is a general idea on what I believe the direction the markets are headed. So that's all I had for today's review. Let's look at what we have in store tomorrow. Now, tomorrow is the big non-farm payroll day at 8:30. Now, if you followed me for any length of time, you know that this event I do not normally trade. Of course, a month, 2 months ago, I had issued a very easy pre-news trade, and that we picked up some trades. This is one of the most traded events, and in which more dollars are lost than any other economic release. If you see any opportunity to trade at all, I will let you know. But I do not think that I have a decent trade plan for the non-farm payroll. But of course, like it's a very major economic event, and I expect it to be lower than anticipated. But Having said that, I expect a very whipsaw reaction. So do not try your straddles. Do not try to get in on the spike. Um, if at all there is a trade which I really, if you're aggressive about, is I would want to, place a order on the USD JPY, a sell order 75 pips above the market, a buy order 75 pips below the market. Hoping to catch the whipsaw. So that's something which is only and only if you are super aggressive. I'm not going to be doing that. So that's it, folks. Talk to you later.